If you take, in the US alone, if you take equities and bonds and look at what's happened since the peak, you will see that the loss to investors is more than twice what we saw in 08, 09. That's how bad this is. So you know what's going to happen. In order to clear the shelves, Nike is going to have to cut prices, and retailers will as well. And we believe this is just a microcosm of a much broader problem out there. And we think we'll see it in full force this holiday season. So you should look for and demand bargain basement pricing this holiday season. Now, November 2nd, they're going to increase, they're saying, pretty unanimously, 75 basis points. And so we took a look at the data for the last month, because the Fed is saying that it's data-driven. So if it's data-driven, let's do that. And so we looked at all of the indicators for this last month, just the last month, and we found 22 firm or strong indicators suggesting employment and inflation might linger at a higher than expected rate. And we found 22 weak indicators. Now, pulling out the ones that are specific to employment and inflation, since those are the two variables that the Fed is weighing more than any other, and we find that on the firm side, what they didn't like was core CPI and PCE at 0.6% month to month, even though the headline indicators were flat to down. The PPI core 0.4, and non-farm payroll, which came out today, pretty much in line, 263,000, but there was a drop in the unemployment rate from 3.7% to 3.5%. Now, the reason for the drop was the labor force, not employment. The labor force shrinking. Labor force participation ticked down. So I don't take that reason as seriously, because we do believe labor force participation will, on balance, continue to trend up, especially if we're in as weak an economy as we believe. So on the weak side, again, if the Fed were data driven, it would be paying attention to employment in the ISM index for September. Below 50% means it's contracting. The job openings, so JOLTS, they dropped 1 million in 1 month. Now still strong at 10 million. They dropped 1.1 million. That's a big drop in just 1 month. So job openings are declining. We're also seeing surveys out there, I think, in the US, among major employers, 300 have announced layoffs, and that's reflected in something called the Challenger Layoff Survey. And those layoffs, which are broad-based company layoffs, are up 68% year over year. I would also imagine that they would consider leading indicators, which in every recession and recovery, in my experience, the Fed has paid a lot of mind to. It dropped 0.3% in the last month, and that makes for 5 consecutive months of decline. And the rule of thumb there is once you've got 3, you know you're in a recession. So the Fed may be saying that it's data dependent, but it's looking at the data it wants to look at. It's not looking at the totality here. It's also making an assumption that we think is mistaken. It's very much a Phillips curve Fed. Now, that's a very Keynes economic theory concept. And it basically says that rising output and employment causes inflation, or they're at the very least highly correlated. That's just not true. If you look at the data, 80s, 90s, 2000s, you'll see that inflation came down during times when the economy was very strong. Why? It's because of productivity. Productivity growth is a byproduct, and a critical byproduct, and an anti-inflationary byproduct of good, strong recoveries. So, we shall see. All right, on to, and I'm going to refer to some numbers here that my colleagues prepared. So let's go to the commodity prices. Again, data-driven Fed. Are you listening? So we'll start with, from their peaks, we've got gold price, the gold price down 17%, copper down 30%, lumber down 73%. Think about that. Housing is collapsing. Iron ore down 45%. Infrastructure around the world has run into trouble, especially China. Corn down 17%. Silver down 29%. DRAM prices, which are chips, semiconductors, down 46%. The Baltic Freight Index down 48%. That's an indicator of supply chain issues. The Baltic Freight Dry Index, which is just for dry goods, down 65%. Oil down 29%. And many people have been dismissing these as saying, yeah, but that's, they went to sky-high prices. They're still not down on a year-over-year basis. That's not true anymore. Gold is down 3%. Copper is down 17%. This is as of today. Lumber is down 28% on a year-over-year basis. Corn is an exception. It is up 27%. Again, Ukraine being a big problem there. We have silver down 9%. DRAM prices down 33%. The Baltic Dry Freight Index down 65%. And oil and corn. Oil is up 14%. That's as of today. It's had a big pop recently. But we do think, having come down from $130 to $90, it is in a downtrend, mostly because of demand destruction. There's another kind of esoteric price out there. I remember it from my days diving deeply into economics. And it's container board prices. This gives you a sense of, how tight the box market is because of a huge amount of trade taking place. So they are down 29% from their peak and about 53% from a year ago. So just taking the evidence and putting it together like this, there is a lot of data to be driving the Fed, which is what they say is happening, but we don't think it's happening. I just rattled off lots of examples. So let's go to the markets and then wrap up pretty quickly here. Not much to say. The markets are selling off across the board, and that's very unusual. It's associated with crises and more convincing evidence to us that the Fed is too tight and that it will pivot. And when it does, it will do so, we think, significantly. Now, first, it might simply be rhetoric, because they always like to tee us up for what the next moves are going to be. And we haven't heard that rhetoric yet, despite all the evidence I just shared with you. But that evidence I just shared with you tells us that the Fed is going to get the message loudly and clearly somehow. And it may not be showing through in the numbers they want to see, but it will. It will. They are huge lagging indicators. They're basing policy on lagging indicators, not what they're supposed to be doing. Anyway, if you take, in the US alone, if you take equities and bonds and look at what's happened since the peak, you will see that the loss to investors is more than twice what we saw in 0809. That's how bad this is, because bonds are selling off with stocks this time. So and one of the reasons for that is a seizing up of liquidity. As I mentioned, if people are facing margin calls or in financial difficulty, they're going to sell their most liquid asset. They will have no choice, especially with margin calls. Most liquid assets tend to be government bonds, and I think that's why we're seeing the backup in government bonds here, despite all of the deflationary signals in the pipeline. Interestingly, one price indicator associated with innovation is beginning to hold up better than other prices, and that's Bitcoin. It's been interesting to see it flatline in the last month, while other indicators are reaching for new lows. Now, this is not surprising in the late stages of a bear market. In our experience, innovation starts to outperform in the late stages of a bear market. Why does that happen? It happens because innovation is the new leadership. Innovation solves problems. Innovation solves the kinds of problems we have today: supply chain, food, energy shortages, think the genomic revolution, electric vehicles, and so forth. And so we believe that innovation should outperform if we're toward the end of this bear market. If the Fed's close to pivoting, even in its rhetoric, I think we are. And we are going to feature on a podcast or a webinar in the next few weeks Steve Vanelli, who is the CEO of Knowledge Leaders Capital. And Steve has done factor analysis, uses factor analysis. He's somewhat quantitative in his orientation, and has defined innovation as a factor. And according to his quintile spread for the R&D to sales ratio factor, he believes that the major underperformance is done. And if you look at the PE to growth ratio of the innovation index that he has derived, it is now selling at a 31% discount to the PE to growth, or the PEG ratio, of the S&P 500. And he noted that this innovation kind of strategy bottomed in May, whereas the broader-based indices, which we would submit are being disrupted, they hit new lows just in the last 10 days. So stay tuned for more discussions about innovation and where the world is going and how innovation is solving problems. So with that, I guess I'd like to reassure you that it feels like we're moving towards a cathartic moment. And, I think that the 75 basis point increase, if that's what the Fed is going to do, is going to result in some financial signals that the Fed will have to pay attention to. Maybe it didn't have to pay attention to the guilt trip, but it should, because it is the reason it should have the guilt trip, because it is the reason that that near Lehman event happened in the UK. And so it is darkest before the dawn. We think the pivot is close, if in nothing else but rhetoric in the short term. And we certainly hope that the Fed gets away from this need for unanimity and a united front, when really we have all of these Fed members and presidents for a reason to debate. And we feel that debate is being stifled. The debate should be driven by data, but it cannot be. If it were, they would not be unanimous in their thinking right now. So let's hope there are some dissenters, and let's hope there's some rhetoric change. There are all kinds of reasons out there, data-driven reasons. And so we hope the Fed is paying more attention to all of the data instead of just a selected few pieces of lagging